So far, the month of September has started out slightly bearish as what most people expected, but we know that we are in a bull market, so any kind of weakness in the months are always good opportunities to add shares of high quality companies. So in this video, let's take a look at what are some of the stocks and sectors that we can take advantage of during this temporary weakness. And I'll also talk about the inverted yield curve and the reinversion of the yield curve that's now freaking people out, foreshadowing a market crash. So if you recall, in early August, we had the biggest drop in the market so far, which was really not that big. In the S&P 500 didn't even drop more than 10%. So it was not really a correction, it was a pullback. And it was triggered by two things. Number one, the fear of a recession because of rising unemployment rate, triggering the SAM rule, as we talked about, as well as the sudden spike in the Japanese yen, causing the unwinding of the yen carry trade. So that caused that flush down in August. And then we had a very strong rebound back for a few reasons. Number one reason was we had stronger than expected economic data. GDP came in stronger than expected in Q2, and we had then strong employment data that came out. But the most important thing was the huge change in the Fed policy. Remember, in the last 3 years, the Fed's main mandate was to kill inflation at the expense of the economy. So if the economy goes into recession, who cares? We gotta kill inflation. But on the 23rd of August, Jerome Powell made it very clear that inflation is now going down. So our main focus is to ensure the labor market doesn't weaken further. We'll do whatever we can to protect the market and the economy. And that is what we call a Fed put. It's like the Fed has bought a put option on the market. So no worries, guys. If the market goes down, we will save the economy. We will save the market. So that has given very strong, bullish confidence to the market, and that's why we had a strong rebound. So what are the other implications of that? So because of that, the Fed, now there's 100% probability that Fed will cut rates in September and cut rates further. So as a result of that, you notice that interest rates are now beginning to come down, long-term interest rates. So if we take a look at the 10-year Treasury yield futures, you can see, whoa, that has really collapsed. All right. So what does that mean? So as long-term interest rates go down, which sectors benefit the most? Interest rate sensitive sectors like real estate, boom, has rallied strongly. Utilities, boom, has rallied strongly. Financials, boom, rallied strongly. And high dividend paying companies like consumer staples, boom, has rallied strongly. So you notice that there's always a bull market somewhere, in the words of Jim Cramer. And in the last couple of weeks, it's been these four sectors that have rallied very strongly, especially within the real estate sector, REITs. So those of you who have been holding on to REITs like me, I've got a whole portfolio on Singapore REITs. Wow, that has been in a very strong bull run and should continue to go higher now that it's very clear that long-term rates are going down, which means mortgage rates are going down, which means the REITs will become a lot more profitable. But this rebound was short-lived for now, because the moment we started in September, we have now begun to pull back again. And this is pretty much expected because the month of September is historically, seasonally a very weak month. Since 1945, the month of September has delivered a negative 0.6% return as compared to all other months that tend to be seasonally a lot more bullish. So February and September are the weakest months on average. And past Septembers have only had a probability of gain of only 45%. Now again, these are all the September months going back since 1945. But this year is a special year. Why? It's an election year. Now if you take a look at past election years, since 1928, you get slightly better September results, but still negative, okay? So these were all the past September election years, 1928, so on and so forth, to, of course, now 2024. It has not yet concluded for this month. And you can see that all September election years since 1928, the average September return is still negative, it's still minus 0.46%, and the probability of gain is slightly better, but it's again only 50%. So out of 24 past September election years, only 12 were positive, 12 were negative. So in other words, it's like a coin flip. So if you ask me, will we end September Positive or negative? I'm telling you now, it's a coin flip. It's like 50-50. Now, the interesting thing is if you take a look at the last 4 Septembers, 2020, 2021, 22, 23, they were all negative, minus 3.9%, minus 4.8%, minus 9.2%, minus 5.4%. So will this be the 5th negative in a row? Well, who knows? It's like tossing a coin, 4 hits. Will the next one be a head or tail? Right? Again, it's a coin toss. So that's not important. What's important is, do we take advantage of this weakness, this temporary weakness? And the answer is yes, of course. Remember, big picture, we are in a bull market. We are on an uptrend. The S&P is above the 200-day moving average. The 50 moving average is above the 150 moving average. And we are in an election year. So all the probability signs tell us that we should end the year much higher than where we are today. And again, if you take a look at the seasonality pattern of election years, September to October is usually pretty choppy and up and down and up and down. But by the end of October, once we get close to the election, regardless of who wins the election, although my bet and my prediction is that Harris will win against Trump, but it doesn't matter what I say because, it is what it is. But again, no matter who wins, we should see a pretty strong rally at the end of the year. So the question is, what do we take advantage of right now? Obviously, we want to buy only high quality companies that are selling at discounts right now. We want to avoid the low quality companies like the Intel, no. SMCI with all that accusations of fraud, no. No, right? So we want the high quality companies. But what sectors do we look for? I still think number one, the first sector to take advantage of is technology. Remember that in the long run, whether it's 3 years, 5 years, 10 years, 15 years, or 20 years, the technology sector, which is represented by the XLK Technology ETF, way outperforms the overall S&P 500 ETF because technology companies, by nature, they've got higher profit margins, they've got more scalability, higher return on capital, and much higher growth. And especially, remember that we are only at the early innings, we are only at the beginning of the AI revolution, which I've talked about, I've pounded the table on many times ever since last year. We are in the 6th wave of innovation. We are in the AI robotics revolution. We're just at the beginning of it. And although prices of the best AI companies have gone up quite a bit since I started talking about it during my 6th wave webinar last year, there are still some high quality companies that are still attractively priced. Here are a few examples. For example, Amazon, in my own calculation, I still think it's attractively priced. My intrinsic value for Amazon is $233, and at $179 it's still undervalued. And recently, with some of the retracements in the tech stocks, and again, the reason the tech stocks have started coming down is not because they're not doing well. It's because of what we call sector rotation. As interest rates come down, a lot of big funds, institutions, they are taking profits on their tech stocks to raise cash to buy utilities, consumer staples, and real estate, and that broadens the market rally. So that gives us an advantage to, again, pick up more tech stocks that are of high quality that are undervalued. So when it comes to Amazon, for example, it's undervalued, and recently it has retraced back to its 200-day moving average, although it looks like it's bouncing back above the 200 days. So I still personally think that it's attractive. By the way, I just added some more shares a few days ago on Amazon. What else? Google, in my opinion, is bloody cheap. Google is bloody cheap. It's been selling off because of all kinds of short-term bad news, which I love. I love it when great companies are hit by bad news because Mr. Market tends to overreact to bad news. Oh my God, we're gonna die. And that gives us a chance to again pick up shares, build our stake of these companies. And what's the bad news? Google has been hit by all these government lawsuits of the antitrust. They're going to break up Google and all these monopolistic practices. And again, this is nothing new. And these cases will drag on for years and years and years. And eventually, the government won't enforce it because these big companies will kind of like pay off the politicians, lobby the politicians, and you'll kill it eventually. It always happens. So to me, it's always an advantage. So like for Google, my intrinsic value is $211. It's right now at $148. It's more than 25% undervalued, and Google has retraced, right? You've got wave up, wave down, wave up, wave down, wave up, wave down to the 50 moving average on weekly candles. And again, no one says it's the bottom. It could still go lower because of some short-term fear, but eventually is going to continue going higher. It's going to rebound higher. It's all a matter of, keeping that long-term perspective. What else is cheap? I think that Meta is not as cheap as Amazon and Google, but it is not that expensive either. My intrinsic value for Meta is $545, so currently at $504 is slightly undervalued, and it's now going through a bit of a retracement on the daily candles. As you can see, we've got a wave up, we've got a wave down, we've got a wave up, we've got a wave down, we've got a wave up, we've got a wave down to 50 moving average. I would wait for a bigger retracement to add more shares, maybe at the 200-day moving average, if you can get there. And if you're wondering how I calculate these, intrinsic values, it's all using my trusty intrinsic value calculator, okay? Where you can, of course, download this calculator once you've taken the Whale Investor course, which I teach, or if you're lazy, subscribe to UIP, where I do all the valuations every month for all my subscribers, and I update all the support levels where we would add shares. So makes it really simple for people to invest. Now again, are all these AI related companies cheap? No, some of them are still too expensive to buy, although I would like to buy more if they get cheap. So an example is Apple. I would love to buy more Apple, but Apple is too expensive. My intrinsic value for Apple is $191. Right now it's at $220, so it's overpriced. And we had this wave down here, but again, it did not drop below my intrinsic value. So discipline, I don't buy as long as it's overpriced. And it rebounded, retraced again, still not cheap enough. So I'm watching this, and I'll only add below 191. Hopefully at 180, 170, I'll be a buy of Apple. When it happens, I can't predict. What else? We've got, let's see, what else is not that cheap, which I would love to buy? Palantir. Okay, so I'm still holding my Palantir. My intrinsic value for Palantir is $28, and it's gone up quite a bit since I bought it and since I announced to my subscribers the notification. In fact, I got this very nice message from Olivia, one of our participants and subscribers. She's up 395% since buying Palantir when I first announced my buy. And I've got some students who have joined me much later, so they bought Palantir later. So like this guy is up, let's see. I've never heard of Palantir before I joined UIP. Glad to ride this journey with this community. It's up 164%. So even though Palantir is up, 300% since I first bought it, since I first owned it, I ain't selling shit. Okay, so stocks like Palantir, expensive. I won't buy more at this stage unless it retraces back below the intrinsic value. Then I'll add more, but I'm not selling. Why? Because to me, Palantir has got a very long runway, and it could become the next Microsoft in the future, right? So long runway ahead, but once it's overpriced, the discipline is not to buy more Palantir. How about Nvidia? Nvidia has gone up quite a bit since I bought it, and Nvidia, interestingly enough, is slightly undervalued. My intrinsic value is 122, and it's now retraced below the valuation at the 150 moving average, is green line, so we could get a bounce back up. Again, there's no guarantee, but I just added some more shares a few days ago in case this is the bottom for Nvidia. If it's not and goes lower, I'll just add more, right? So my philosophy is that great companies will always go up. Always go up, right? So if it drops and I buy, it drops more, who cares? I don't have to buy at the bottom. I don't have to buy at the bottom. Confucius said, men who try to pick bottom only get smelly finger, all right? To me, as long as I buy at a potential bottom is good enough. And if there's a lower bottom, then so be it, right? As long as I buy near the bottom, I'm going to make a lot of money over time. Now, besides technology stocks, which are in a long-term secular growth trend because of the AI revolution, I think that right now there's a lot of opportunities in consumer discretionary stocks. Now, what's consumer discretionary? Think of kind of like luxury goods. Think of branded items, right? And historically, if you look at the last 5, 10, 15 years, consumer discretionary stocks have always outperformed the S&P 500. As you can see, this is the XLY, the consumer discretionary ETF, has always outperformed the S&P over the long run. However, recently, Recently, you can see that consumer discretionary has underperformed the S&P 500. Why? Why? Because of high interest rates. So when interest rates are high, inflation is high, people kind of like spend less on these luxury items, these branded items like your Lululemon and your Ulta Beauty and your Estee Lauder, your LVMH. And so these stocks have actually come down quite a bit in the last couple of weeks and months. But the good news is that when the Fed starts cutting rates in September, guess which sector tends to rebound the fastest based on history? You got it, consumer discretionary. So you can see from this table, this is from Bank of America Global Research, you can see that this is the time the Fed cuts interest rates, which will be in September. 1 month, 3 months, 6 months, and 12 months after the rate cut, consumer discretionary tends to outperform 89% in 1 month, 78% in 3 months, 89% in 6 months, and 44% in 12 months. It is the best performing sector in the entire market the moment the Fed cuts interest rates. So this could be a good time to position into consumer discretionary stocks. Now, again, not all of them, but the higher quality ones. So what are some examples? Luxury goods. For example, LVMH, which is listed in the US under LVMUY, which is an American Depository Receipt. You can see that has come down quite a bit. And there we are. You can see the big retracement in LVMH, and it's right now at this long-term support. And it is below the intrinsic value of 171. And it looks like there is a pretty high probability that it is near the bottom. Again, there's no guarantees. It could go lower, of course. No one can predict exactly the market in the short term, but if it's undervalued, in the long run, these high quality stocks will eventually rebound to higher highs. Another example would be Lululemon, which I have to say I've got a bit of bias because almost everything I wear is Lululemon. In fact, this t-shirt is Lululemon. My wife and kids, they shop at Lululemon at least twice a week. My wife buys all my clothes for me, and 80% of what she buys is all Lululemon. Everything is Lululemon. They're all crazy Lululemon people. Okay, so a bit of a biasness over there. And Lululemon, again, a short-term temporary weakness because of some executional screw-ups in management, plus the softening of demand for these goods because of inflation, high interest rates. But that would reverse over time, right? And you can see Lululemon has really gone down quite a bit, and it's below my intrinsic value of $357. All right. Last example would be Ulta Beauty, which I bought, and the next thing I knew, it was announced that Warren Buffett, through Berkshire Hathaway, took a stake in Ulta Beauty, which was interesting. Is he copying my trades? I'm just kidding, of course not, right? Yeah, but Ulta Beauty, again, traditionally a very high growth business in the beauty market, and right now undervalued. My intrinsic value is $429. It's now trading at $373. So it is undervalued. And again, if you believe that women would always want to be beautiful, that this is eventually will re-accelerate the growth, then it could be an opportunity to pick up these high quality companies when they are hated and marked down. By the way, if you take a look at the monthly chart on Ulta Beauty, you can see that on the long-term monthly chart, there has been a strong support at this 100 moving average, which it just touched, and looks like it could be bouncing off this 100 moving average. Could be. Finally, let me talk briefly about the yield curve disinversion signal that the media has been playing up. The media like to scare you. They say that, traditionally if you look at the 10-year minus the 2-year yield curve, the moment it inverts, hold on, let me get my pen over here. The moment it inverts and disinverts, recession in gray. Inverts, disinverts, recession in gray. Inverts, reinverts, recession. Inverts, reinverts, recession. And what they're now saying is that the yield curve inverted, now is disinverting. Recession is coming, right? And if you read what they're saying, they're looking at the 10-year treasury yield minus the 2-year treasury yield. The first thing to understand is that the guy who invented the concept of the yield curve inversion, his name is Harvey Campbell. Now, if you read about Harvey Campbell, you can go and Google and read about his thesis. He doesn't use the 10-year minus the 2-year Treasury yield curve. He doesn't use that. So they are making shit up, right? What he uses is the 10-year minus the 3-month Treasury yield curve. So this is from the inventor of the yield curve inversion, right? And if you take a look at the 10-year minus the 3-month, it has not yet disinverted. You can see that the 10-year minus the 3-month is still inverted. It has not yet disinverted, all right? So that's the first thing to understand. Now, will it eventually disinvert? Yes. When will it happen? I don't know. So if that happens, does it also mean, oh my God, it's going to be a recession? Maybe, maybe not. And let me explain a different point of view if you actually read into it. Now, first of all, a lot of people, they like to look at these signals very blindly that, oh, the yield curve inverted means a recession is coming. But you have to ask yourself why. Why does an inverted yield curve mean a recession is coming? And is it the same reason this time? So let me do a bit of explaining. Now, if you take a look at what Harvey Campbell wrote, who is the inventor of this concept, he explains, the safest asset in the world is the 10-year Treasury bond. When people believe that there's an increased risk of a crisis or recession, they shift their assets into the 10-year Treasury bond. So in other words, when people get scared, oh my God, a recession is coming, what do? They will buy the 10-year Treasury bond. Now, when they buy the bond, what happened? The bond price will go up. When bond prices go up, the yield will drop. Remember, yields always move opposite to bond prices. So when the 10-year Treasury bond yield drops below the 3-month Treasury yield, that's an inverted yield curve. And that predicts a recession because of this reason. All right. So the thing you have to understand is the reason the yield curve inverted this time was not because the 10-year Treasury yield dropped. No. In fact, the 10-year Treasury yield went up. Let me explain. And let me show you this chart over here. So over here, I have plotted on this chart the 10-year Treasury yield, and on the lower chart, this is the 3-month Treasury yield, okay? So initially, the yield curve was not inverted, which means the 10-year yield was at 1.18%, which is above the 3-month Treasury yield of 0.07%. So this is not inverted. Now, the yield curve inverted in October of 2022 right here. This was the inversion. But notice something interesting. Unlike past yield curve inversions, it was not because the 10-year yield went down. No. In this case, the 10-year yield actually went up. It went up from 1.18% to 3.8%. But why did the yield curve invert when the 10-year yield went up? It's because the 3-month yield went up even more. The 3-month yield went up from 0.07 to 4.1, and 4.1 is more than 3.8, causing the yield curve inversion. Ta-da! Okay, so what does all this shit mean? This means that the reason the yield curve inverted this time was a different reason from all past inversions. It was not because of the expectation of a crisis or recession. It was because of the Fed raising short-term rates aggressively to combat inflation. So does that mean there's no recession? Again, no one can predict. There could be a recession. Maybe, right? But what I'm saying is that you should not blindly look at this yield curve signal and say, oh, a recession is coming with the yield curve. Use your brain, ask yourself why, okay? So that concludes this video. I hope it's been useful. Again, no one can predict the market, no one can predict the future, no one can predict the economy. As great investors, all we do is we look for great companies, we buy them at discounts, and despite future crashes and recessions, we will grow our portfolio over time. Thank you for watching, and as always, may the markets be with you always. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com, where you're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.